Hi, and welcome to your weekly macro roundup, where we talk macro, trying to make sense of markets that really don't make any sense. But more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today because I've got a great show lined up for you today. And right out of the gate, I got to change directions because I got a question. Someone said, well, Steve, I understand you have a lot of older clients. And honestly, I mean, does demographically make sense that I would. Actually, probably half my clients are under the age of 50, but in terms of asset, obviously the older clients are going to have considerably more. But I said, well, so how do you do macro for younger people? Now, I answered the person's question, and I realized immediately I answered it wrong. And so I went back and said, look, I'm going to amend my answer. I'm going to answer it on my show because macro does not discriminate based on age. It's not an age strategy. Let me give you an example. Let's say that your thesis is that interest rates are going to zero. Now, what would be the most logical investment that you would want to buy to capitalize on that? Well, you'd want to buy U.S. Treasury bills, notes, or bonds, or U.S. Treasury securities, just to generically lump them all together. Now, from a risk perspective, let's say you had someone who's quite older. Where would you put them? Because macro, you could slide the risk dial. So if you want to take a little bit of risk, then you'd go to T-bills. If you want to take more risk, you could go to Treasury notes or intermediate term Treasury securities. If you want to take more risk, you could go long bond. You want to take more risk, you could get out there. But what macro is, it's a risk reduction strategy. So let's just pretend that, of course, I believe that interest rates are headed to zero and I want to take the maximum amount of risk. So I'm at the knife's edge of risk of stuff that you didn't even know existed. So when you look at like, man, where's Steve? Oh, he's taking an insane amount of risk. But from a macro perspective, as we've gone through this thesis together, is that overly risky position that I could take as risky as it would be? And the answer is no. That's the beauty of macro. So if I want more risk, I just go out the yield curve. If I want less risk, I go inside the yield curve. Okay, so think about this. If that doesn't make sense to you, let's think about we're now at the major market bottom, and you wanted to take risk, and you're younger, and your parents came to you and said, son or daughter, you're selling us the markets at a bottom. We're sitting in cash. We should buy stocks. So what would you recommend? Now, would you recommend that your parents buy high-risk stocks? No. You're probably going to tell them, buy blue-chip stocks, mom and dad. Why? Now, they're not going to have the same upside potential, but they're not going to have the same downside risk. Again, you could slide the dial. Now, if you're younger, what kind of risk might you take? Well, you might buy small-cap stocks. You might buy emerging market stocks. You might buy high-risk tech stocks. So you could dial yourself out where you want. All macro does is just reduce your risk in that position. Isn't that cool? So people think, oh, macro, you can't make a lot of money. Oh, you can. It just all depends on how much risk you want to take. But as a style of investing, it reduces your risk. See, I know that interest rates have gone up a little bit this week and they came down today. Does it really bother me if I'm positioned in treasuries? No, because we'll look at the data again today. The data says that I have an extremely high probability of being right. So I can take an absurd amount of risk, and it's not as risky as it is at its face value because of macro. That's what macro is, and that's how you do it for young people. Now, if you like to trade, maybe you're a day trader, you can still do that, but you could just have a chunk of your money that maybe is allocated to, macro. But you dial the risk. It doesn't work the other way around. So hopefully that answers your questions. Now, I do have two updates for you. One, we do have a new channel manager. My wife notified me last night that she is appointed herself as the channel manager. So if you see Kim reply to your post, that is my wife. Someone said, what do you look like? Well, here's a picture from our wedding 8 years ago. In case you're confused, this is me. That is her. I know you weren't sure, but just in case. So there she is. I will not guarantee if she'll reply to you, but she said she will. She'll be there from time to time. So I know she'll read them. your comments so you can have fun. Next, Dad called to say that I could tell his story. A couple of you sent questions in. What did your dad do? Well, on Saturday or Sunday, I don't know what day I'm going to release it yet, but I am going to do a Q&A video. I've got, I don't know, around 15 questions. Perfect Q&A video. So if I don't get in today, I'm going to put them all there, or share with you the story of what did Dad do and how did that completely change our family. In fact, he called me and we were talking about it. I said, could you imagine had you not done that? And he goes, yeah, total different outcome for our family. So I think that's pretty interesting. Now let's get into the data, because I have some other stuff I also kind of want to talk about as we go through this and really try to put more emphasis on identifying what the data is. Now that I feel better about shifting the questions under our new format, or maybe to a separate video as part of like a weekly series or every other week, depending on how it goes. Yes, this is recorded live, by the way. No edits. I don't believe in them. So let's get into the data, the banking data, because this really tells us a lot of what's going on. So the banks closing out the week of May 20th, as Treasury yields were rising and everyone was going crazy about inflation. If you look at securities and bank credit, they went up about $23 billion. So again, kind of as I thought, the banks are going to take advantage of these higher yields. Now, I also believe that the banks or the smart money, I mean, why do you think, Goldman Sachs puts people from its bank into, the different presidential administrations? I mean, look, they want information. If there was any question that what happened today with President Trump's press conference on China was already kind of known and being talked about, who do you think knew this? Of course, the big commercial banks. And why would they let Treasury yields float up? Because they wanted to buy. And they knew they could kind of entice people to sell and short. We'll get into more of that a little bit later. But yet they were buyers this last week. Coming down to loans and leases at all commercial banks, big drop of $59 billion coming mostly out of commercial and industrial loans. So all of a sudden this big surge in commercial industrial lending is reversing. Now, does this mean that there are some major defaults happening? Possibly. Or it could be that some companies are paying those what are called revolvers back, their short-term line of credits, and so maybe they're issuing stock and they're paying some of this back. I don't believe we're seeing a lot of defaults. We're seeing some bankruptcies, but we're not seeing outright defaults. At least I'm not seeing it in the news. So it tells me that they're paying back their short-term line of credit. How about real estate loans? They're down a couple billion. Look at residential, down $5 billion. And I've got a bone to pick with some of the people on Twitter on this, and we'll get to that shortly. How about consumer loans? Down $4 billion. So, when you look at this from an economic recovery standpoint, you don't see it in the consumer. Look at they're paying down their credit cards. We continue to see week after week credit card balances going down. We're going to talk about that. So this is really interesting to me. It tells us this V-shaped recovery being priced in by investors is not in the economic data there. So let's go look now at some of the underlying economic data. And I want to do more of this going forward. And I think we could have some fun and learn a lot from this. So let's just start with what happened on Thursday. If you're wondering where I'm at, I'm on investing.com. Under news, you can go to economic calendar and you can watch this every day. If you get their app, which I do not get anything from you downloading it, but if you download their app, you can get this on your phone too. So looking at today, we see something very important is personal consumption expenditures. And that's today. This is Thursday. On Thursday, we see durable goods orders. Now, durable goods, there's a chart that I really like that Dr. Chris Dark helped me put together. And this tells me the demand from the consumer. And what we look at is durable goods excluding defense, because obviously none of us here are out buying defense stuff, minus value of manufacturers' new orders for transportation equipment of non-defense aircraft and parts. Reality is most consumers do not own airplanes. A small number do, but not consequential to, you're not going on Amazon and like, man, I need a new wing for my airplane. This is not happening. But so what this tells us is demand from the consumer sector crashed at a rate of 23.4% from this time last year, of which in the history of durable goods new orders is a massive crash only now at the second lowest point since the great financial crisis. So what we're seeing in the data, and I understand you can say, well, it's this lag because it's April. Yes, it is. It is a leading indicator that demand from the consumer sector is down. So let's come back to the investing.com and look. Continuing jobless claims. This is very interesting to me as well, because continuing claims tells me how many people are still receiving claims. Because you can file for an initial claim and then end up going back to work, like the following week. So you might only get one check and then go back. This tells us people who are continuing to receive jobless benefits. Now, a little bit of good news, it dropped from roughly 25 million down to 21 million, but still 21 million people out of work is a lot. Now, do I expect this number to go down? Absolutely. As states reopen, this number should fall. Does that immediately mean, well, that's super bullish? Look, if you have even 5 million people collecting continuous jobless claims, you're in a recession. So the reality is, no, this number is pretty high, and I doubt it's going to magically go way down. I mean, I wouldn't be surprised if this number, flows between the 10 to 15 million range. That is still extremely recessionary and not to be taken as a major change in the economy. Let's continue down to today's data, which is personal consumption expenditures. This is the Fed's preferred gauge of inflation. Now, we were right about the CPI call. Well, this is what the Fed really looks at. And for the month of April, personal consumption expenditures dropped minus 0.5%, deflationary. The year-over-year rate of change went from 1.3 to 0.5, disinflationary. So here you see completely validating data that says we're in a deflationary environment, which is notably interesting to me because in the consumer sentiment survey for May from the University of Michigan, inflation expectations jumped. Now, this is consumers that they survey. So consumers are kind of buying into the fact that they think inflation is coming. So after all the news that, hey, the economy shutting down is inflationary. Now you don't believe that? Okay, the economy reopening is inflationary. All right, well, you don't believe that? Okay, the Fed doing quantitative easing is inflationary. Oh, wait, the Fed reducing its quantitative easing is inflationary. In fact, it's just like, here, let's just go through the bazillion things that everything is inflationary. Hey, and finally people believe it. Yeah. Anyways, what I find interesting is personal income shot up. Why is this happening? It's because government transfers are paying people more money than they were making it work. But look at personal spending. So you see minus 13.6% in April. Real, when you see real, think inflation adjusted personal consumption down 13.2%. So what you're seeing here in the data is something very, very important to think about from a macro perspective. People have more money and they spent less. Now that's very interesting. So let's kind of break down what this might mean. Because you could say, well, a lot of stores were closed. All right, think of this $600 weekly bonus, or what, I don't know what the federal government refers it to, that expires in July. Think of it as a bonus, not a weekly bonus, but say a one-time quarterly bonus. So let's just pretend you're at work. You've never gotten a bonus. Your company is never known for doing any such a thing. But one day the big boss calls you into his office and says, hey, you have done a really great job here, so I'm going to give you a one-time quarterly bonus. Wow, that's pretty cool. Don't tell anybody, but I can give you a bonus. Now, how do people handle bonuses? Well, if they're small, what do most people do? Hey, they go out to eat, right? Hey, everybody got $500. Let's go out to eat and, go get some ice cream or whatever. And we'll go to the nice restaurant, get the filet mignon and the lobster or something, whatever, right? That's what people do with small bonuses. Now, what do you do if you get, say, a decent sized bonus? Oh, maybe you need a new computer, a new TV. Maybe you need, a new lawnmower or something, some big equipment or an upgrade for your vehicle, something that's just a bigger ticket item that you maybe are wanting to buy, saving for, but boom, now you've got it. Now, what do people do with a big bonus? They go on vacation. Now, obviously, people couldn't go on vacation, but could they buy TVs? Yes. And all that junk? Sure, they could have. They didn't. Could they have eaten out? Yeah, a lot of restaurants were still doing takeout. They didn't do that. So what is this telling us? Because we're hearing from different people in the government, oh, there's going to be all this inflation and all this pent-up demand. And consumers are saying, not only did I get a bonus that I didn't spend, maybe I put it in the stock market, but nevertheless, but I also cut my spending. So it tells you that the American consumer is concerned that they may not be going back to work in July. And if they do go back to work between now and then or later, they're not going to be making as much because their hours are going to get cut. Now, all this money theoretically could be inflationary, and I'll give you how it can be. If everyone did go back to work, so those 21 million people that are on continuing claims, everybody goes back to work, all back at the old wage, everything's fine, and you've got this extra money, now you could go spend it. But how inflationary is a one-time bonus? Because what's the difference between, let's say the big boss calls you in the office and says, you know what, instead of giving you a one-time bonus, I'm just going to give you a nice pay raise. Now what can you do? You go, man, I've been driving around this 10-year-old car. I now have an extra, $1,000 a month. I can go finance a new car. And when you finance something and borrow money, that is how money is created. That's where you get inflation from. But a one-time bonus either gets saved, spent, or used to pay down debt. So what are we seeing? We're not seeing it spent, we're seeing it saved, and we're seeing credit card data paid off. We know what the consumer's thinking. They think things are much worse than the stock market is telling us. So I think that's important to understand. That's kind of how I interpret the data today. Obviously, you could be free to interpret differently, but nevertheless, that's how I saw it. And I want to do more of that. And I might be wrong, but you're free to ask questions, bring in your opinion, because this is our show. It's not just me, it's you too. We're all here together. We're all here to learn. I'm not certainly always right, as I'm sure some of you will point out to my wife in the comments below. All right, let's take a look at the broad economic data. The M2 money supply is flattening out at 23.42%. And of course, people on Twitter go crazy about this is inflation. Sorry, it's not. The 6-month rate of change is flattening out. The 3-month rate of change is flattening out. And what I want to share with you is what's going on in the money stock measures, because the institutional money funds, which is, remember, this has been the big driver, this and commercial bank deposits. So commercial bank deposits are flattening out. And what about institutional money funds? Starting to flatten out. So what is this telling us from a macro perspective is when we do get to the chart on the money multiplier, remember what I talked about, that it's the M2 divided by the monetary base. Well, if the M2 starts to slow down or flatten out or even roll over and go down, the Fed's monetary easing, which is really deflationary, will keep pushing up, causing the ratio to go down. It'll be bearish, and that will trigger deflation or more deflation. This is important when you think about how you're positioned, how much risk you're taking, and if from a macro perspective, you're reducing your risk by understanding where the data is coming from. So I wanted to show you that because I do chart this on a 3-month rate of change, and it is pretty much flatlined. And that is great for my position, or my thesis, I should say. Next up, the monetary base, which the Fed claimed that when they came out with the new data point that they were going to update it weekly, and now mysteriously they're not. So we're back to the old format with a new chart. Nevertheless, this will continue to rise because the Fed has said and made clear that they're going to continue easing. Maybe not at the extreme rate, but they're going to continue. And that's all they need to do is continue easing, especially if the money in institutional money funds starts going down. So here's the money multiplier. It's really been flat for the last 5 weeks at 3.52. It tells us deflation is here. It tells us that this should continue to fall because the M2 is peaking and the Fed is not stopping. So this is completely validating my deflationary view. Now, here's my beef with Twitter today. So, oh shoot, I was on the wrong part, wasn't I? Boop, there you go, sorry. Here, not updating. There it is at 3.52 flat, should head lower. now real estate loans. All over Twitter, all I see is, oh, look, inflation's coming, green shoots are coming, the consumer's coming back, because new mortgage numbers are rising to multi-year highs. So what? So what? Macro isn't just about one statistic. Macro, in terms of inflation, is money creation. So, hey, it's great that people out buying homes get new mortgages, and maybe that will help kickstart the economy. What is everything else doing? Nothing. So look at total real estate loan growth at all commercial banks is falling. It's down to 3.97%. And the 3-month rate of change continues to tick lower. So the good news is, yes, some people are out getting mortgages. The bad news is not anywhere near enough to stabilize this, with mortgage rates pretty much at all-time lows. And that is a problem. So the green shoots is really not all that green. If we look at commercial industrial lending, as we kind of know already, it turned down a little bit, so it's headed lower. This may be the peak. And taking into account loans and leases at all commercial banks, the growth rate is rolling over and heading down. And that, again, is just because this is a combination of mostly the prior two charts. And looking at credit card loan growth rate, again, this is not showing consumer spending. Growth rate is down minus 6.38%. Consumers are either not using credit cards and or paying them down. And that is very, very important, because if we were going to see green shoots and a V-shaped recovery, I'd want to see this thing shooting higher week after week. And I'm not seeing it. I'm not seeing it at all. I'm trying to remember what I wanted to talk about, and maybe I'll think of it while we go over how hedge fund managers are positioned, because we haven't talked about that. And I'm trying to remember. I'll think of it after the show's over, probably. Anyways, we'll save it for next week, perhaps. Looking at 10-year Treasury note futures, speculators backed off a little bit as of the last week's close on Tuesday, for the more futures contracts for the reporting period close on Tuesdays of the week. And looking at 30 years, they backed off a little bit. It still doesn't change the picture that the market is very, very short Treasuries. And you can see this in the charts. Not me here. In the charts, because if you look at, say, 13-week Treasuries, yields flat. 5-week Treasury yields almost back, it headed back near their low, all-time lows. 10-year Treasuries, pretty much flat. 30-year Treasuries, now why are they up? Because of the aggressive short position. They're not up because there's something weird going on in the 30-year market. It's because it's aggressive selling and shorting of the long bond, trying to get rates up. That's what's going on here. They're trying to do that, and it's not working. And even though I'm not a big fan of moving average strategies, what you can see is the moving average, the 50-day moving average, is acting as overhead resistance on 10-year Treasury yields, and again suggesting they're headed lower along with the 30-year long bond yields. And look here from a technical perspective, sellers have pounded on this 1.4% door, didn't get it. Pounded on it again, didn't get it. Pounded on it some more. And with technical analysis, when you knock on a door enough times, you can get through. And then they said, okay, well, look at, we got this time the highest point in 2 months, and then all pretty much rejected in one day. So you keep seeing them knock on the door, and if you knock on the door enough times, like I said, the view is you get through. But if you knock on the door enough times and the door stays locked, yields go down. Money multiplier is the best, hands down, the best predictor of inflation. It tells you when it's coming. It's going to be your first point of contact with inflation, and it's flat. So we know all this move in the Treasury market recently, all this going on right here, is all speculative positioning. All it is. It's not going to hold based on what we're seeing in the data. All right, let's get back to how hedge funds are positioned. And we can come down here. people are really bullish on crude oil. One of my friends sent me a picture of the floating storage out on the California coast, and I asked him, he was like 40-year veteran of the oil industry, and I said to my friend, have you ever seen this many ships out here? He said, not in my life. I said, how bad is it in the Gulf of Mexico? He says, oh, way worse. You know what doesn't get counted in the government reports for crude oil storage? The stuff sitting out at sea. Not pretty, but people are betting on a massive recovery. S&P 500 futures still, hedge funds are very short. Why are they short? Because they're hedging their long positions. We do know the hedge funds are holding long, not long futures positions, but actual positions in the cash market. They're long, so they're hedging their long position with futures contracts, which would make sense if that's what they're doing. Gold continues to see its long contracts back off. That should support gold heading lower. Also kind of validates my view that as real yields rise, gold heads lower. And if you can't break through and you back off your longs, gold price is going to head down. Looking at the NASDAQ, we see hedge funds last week started to short it, and they went long the Russell 2000. That's kind of interesting. The dollar, which is actually breaking down, I'm still holding to my rising dollar thesis, but from a speculative position, hedge funds are still up, and the dollar is starting to fall. And then on the VIX, or volatility futures, they're short volatility. So if you look at it, they're long stocks from a cash position, short vol, which means if you're short volatility, you want stocks to go up, and they're hedging that in the futures market with the S&P. So that's pretty interesting. I still can't remember what it was I was going to share with you. Man, it was good too. I just can't remember. Let's go look at some charts for fun. All right, on to the long bond, TLT. So again, looking at the reverse of Treasury yields, we see buyers keep coming in right under this 1.4% is roughly where this lower purple line is, and we can see today in the action after, as President Trump talked about China, shot up, went into a consolidation pattern, tried to break up, and then got heavily sold right at the close for some reason or another, and at the moment appears to be holding support where it has been previously resistant. So when prices move through what's called overhead resistance, so you see it knocked on the door, rejected, this is resistance. Knock on the door, this starts becoming resistance where there's sellers at. When you break through here, when you break through resistance can become support. So it's normal that it would go through, come back and check in with it. So we'll be curious to see what it does going into next week, because with all of these short positions, this thing should be somewhere up here. And you can see, looking at the 7 to 10 year Treasury ETF, it's above its 15-day moving average flat. So you can definitely see this heavy shorting. So as that comes out and we break into a bull market and another bull market in bonds, this should rocket up higher. How about the dollar, which would indicate that bond prices should be headed lower and yields higher? Again, you see definitely people trying to create the view of inflation, trying to support, hey, the dollar is weakening. Let's make the world believe there's inflation when the money multiplier clearly says they're not, but they're pushing the dollar down, which is helping create liquidity, at least in the emerging market sector, but still in Steve's zone of doom. So nothing breaking through here yet. Now, as I mentioned before, if this broke through, I might have a change of heart, but the money multiplier is really telling me, based on the data from the institutional money funds and the Fed continuing to ease, that even if it does tip its nose above that line of doom, we're in a very deflationary environment. The market has not figured that out yet. It just doesn't really know. Let's see what else is of interest to take a look at in the charts. Nothing really. I wish I could remember what it was I was going to share with you. It has something to do about lending and creating credit, and I just don't remember what it is. But I'll think of it hopefully for next week. So I'm going to wrap up. Get this upload, record the question and answer for this week. I'm not sure if I'll put it up Saturday or Sunday, but I got about 15 great questions to go over with you. We'll try the new format, and hopefully that will work out really well. And I appreciate you taking the time to watch. I appreciate your feedback and being part of the show. And as always, I'm Steve Van Metre. Thanks for watching. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. It chose not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in the video that are own and do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.